the markets gave us an indication that they were going to start turning over. As we could see in the Dow, we had a hanging man signal over the past few days, which told us to beware, but we still had the trend in an upward direction because it wasn't closing below the T line. The next day, they traded lower, confirming the hanging man signal, but they still didn't close below the T line. However, the one practice of candlestick analysis is let the signals be your primary guide, and everything else is a confirming indicator. The next day, yesterday, as we saw, they traded lower, but closed right back on the T-line, making today's analysis of which direction the trend should move very simple. If they opened up positive and traded positive, the probabilities were that we were going to move higher still. However, the other contingency was we had a sell signal. We needed to stay above the T-line today. If it started backing off, that told us that this signal pattern was starting to show weakness in this market. Will it always trade off this hard? Not necessarily, but as a candlestick investor, we could be prepared that if it did reverse, we wanted to be changing positions, closing out long positions and adding short positions to the portfolio. The Nasdaq also gave us some warning in that after it had closed with this is two dark crows, and then a left-right combo that closed below the T-line. Yesterday, when they took it back up, they didn't close it back up above the T-line, but they showed there was still buying around. But the fact that they opened up positive today and it immediately started trading off was a sign that maybe they weren't taking this market up. We better be careful what the signals were telling us. This just allows a candlestick investor to be very aware of when there might be a change of investor sentiment. This allows us to take advantage of opportune times to go short on positions. Our recommendation today was on BBRY. It came up, it opened and went positive. Nothing wrong there, but when we saw the market start getting weak and coming back down below the doji, that told us that was time to go short, because now what we have is a bearish doji sandwich with a booster on it where it failed at the T-line. Told us that the moving averages weren't going to be acting as support anymore, and that bearish doji sandwich told us more than likely there is more downside. This is where you want to be ready to go with the flow. If the market turn, have positions ready, and this provided very opportune entry strategies. That it came back down through this level after failing at the T-line and the market is selling off. That was a good indication that this downtrend was going to continue. But again, the market conditions also illustrate why candlestick signals and patterns usually have strong results based upon what the chart pattern is telling you, not what the overall market is doing. We put a buy recommendation on AMRI today on a positive open because it had a left-right combo bullish candle setting up for a perfect J-hook pattern that if it broke out through this level, we wanted to be buying. This stock was up pretty strong on a day when the market was selling off heavily. Once again, to illustrate that candlestick signals and patterns are the accumulative knowledge of everybody buying and selling. That can even include that they were buying this for some reason, even though everybody knew the market was selling off very strong. That'll be it. We'll see you in the chat rooms.